All right. Well, if not, we're going to jump right into the agenda, and I will pause after each of these segments. First, we're going to just do an introduction as to why we're starting these webinars up again, hopefully how they can serve you and your family. A little bit about investment consulting, an advanced planning idea. We're going to talk about asset protection today, and then a relationship management, which is really who are you as a person, as well as how can we help you work with other professionals. So we had lined up a CPA for today that unfortunately is not going to be with us due to some travel restrictions on her work, but certainly had some Q&A from her and some stuff I'll bring to you guys when we get there. So from that, we'll then jump up to conclusions, and we're trying to figure out what the cadence should be on this, if it should be monthly or quarterly. We've previously done monthly. Would like to get back to that. I think that might be nice. So before we start, any questions or anything y'all want to be sure that we get into before we jump into some of the investment stuff? All right. Well, before we get into the upcoming economic update as well as the investment consulting, let me just pause and let's go back and start this in prayer. And the reason I start these meetings in prayer has a lot to do with the importance that brings going forward, but also we originally started doing these updates during COVID when we weren't able to get together in person, found a lot of value there. And also at that point in time, just really need to lean on the Lord in a way that we want to continue doing since then. So let's pause and then get into the economic and investment update, and then we'll go to some planning ideas. God, thank you so much for today. Thank you for bringing us together. Help the conversation we have, the ideas we share, as well as the plans we make to better benefit you, as well as help us glorify your cause. In your son's name we pray. Amen. All right, so let's jump into the economic update and investment side on the investment consulting. So first thing, and this is very important to remember right now, and part of the reason I'm saying we need to remember this right now is that, and hold on a second, Julian, I'm just think about the market changes, when the economy changes, when a lot of things change, what happens is not that we can't stay on the same plan that we're on, but we may change the way we invest. We may have different opportunities in different places. We may measure risk differently, quite frankly. So when I look at this, you have to always think about with your own personal portfolio. And remember, when I'm talking to you guys, I'm talking on more of a global level, whereas on an individual level, you all may have different portfolios in place. On an individual level, it always comes back to risk. So we kind of divide most people's assets up in 2 or 3 ways. First of all, what are you spending in the next 7 years? And we want that in bonds or fixed income, guaranteed payments, something like that, that will be very secure and we know it's coming no matter what. Then when we think of money that we're not going to use for a while, we can put that in stocks. And all of these styles we're talking about have different posturing. So when I think about the posturing in bonds, and we're going to talk about this a little bit later with how interest rates have come up, and so how that can create some opportunities we haven't seen in the past. When I think about bonds, what I'm thinking about here is how do I, under capital preservation, just make sure we preserve the money? How do I, under core fixed income, try to grow the money above inflation? And how do I, under alternative income, try to maximize return in the bond part of the portfolio? Come down here to stocks, you're thinking about low volatility. How do you preserve capital in a down market? Core equity, how do we maintain it in a normal environment? And opportunistic equity, what opportunities might be in front of us? And we're going to talk a little bit about both of those, but also remember your returns that we're talking about depend a lot on which of these strategies you're on and not just the overall market. So first of all, what is happening with the overall market? Are there things that should make you feel more comfortable or should make you feel more concerned? I don't think any of those things should change your strategy. I think your strategy should remain more based on your plans and what you are trying to do from an income standpoint. I think on the tactical level, though, we might make some changes in your portfolio based on what's going on in the current environment. And so because of that, and the reason I say might, first of all, is we aren't going to make those changes unless they're important to help you better meet your goals. But once we find that that might be the case, we start thinking about what changes should be made. So first of all, one change we've seen in the market, and this has been basically a decade, compressed into 3 years. If you think about COVID, the market cycle that happened, the interest rate cycle that happened, and all those things. First of all, inflation is cooling. That is a huge positive for both the stock market and the bond market. It's a huge positive for the bond market, your more conservative money, because what happens is now we have these higher yields due to where inflation was, and we're able to either benefit from those yields or possible some capital appreciation as those go down. And then for the stock market, because now all of a sudden we're dealing with earnings that matter more because we have less inflation. So we're moving back to a more efficient supply chain, which is really what got inflation so low, and was certainly disrupted by COVID. One of the things that we're also experiencing at the same time, so that's very macro. The other thing we're experiencing at the same time that's more on the micro level, that's maybe some of y'all, but also just the consumer and the economy, is during COVID and the 2 to 3 years that followed, people really saved an unprecedented amount of money in their household savings. And with that, it really put the quote consumer in a great place to keep the economy going. One thing we're seeing now over the last year is as economic stimulus from the government is pulled out, we're having less and less savings in place for the average household. And because of that, their spending power is going down. So we saw a lot of spending power. So you're feeling, and I'm just telling you this so that whatever headline you see, you can try to distract that from the news you're watching. Remember, the news's job is to make you watch the news and compare it with the overall situation, which is, yeah, you're kind of having this ability to spend balanced out amongst individuals, but you're also having this inflation headwind cut down. So, in my perspective, both those kind of balance out, and neither is an investable issue, but I think both are the kind of thing that you as clients and investors are going to hear as noise, and I want to keep you away from, so you don't make bad decisions at the wrong time. We also have something where, for the first time in a long time, the Federal Reserve, and let's go back to the significance of this, actually overdid rate expectations, meaning this green line, if you go to it, is where the market was expecting the Fed to raise to. And finally, they actually met that and went above it. So the idea of this, if you look at this chart, is back in, let's say, July of 2022. It's not saying that the market was perfectly efficient at that point in time. What it's saying is the market expected a longer term rate from the Fed of this green line. And what you've had is a ticking up of that gradually, and then it exceeded it. Where I think that's going to create some opportunity, and we're going to come to that here, is maybe part of the downturn we saw last year overshot. And because of that, there may be, and I hope this is there are, both for your bottom line and ours, opportunities in parts of the stock market, parts of the bond market that weren't there before we had that part of the cycle. So if you look at this, and this is really important because a lot of what I try to help y'all do on these webinars is go to what matters for you versus what is the noise you're hearing. And a lot of the noise we hear is very much around the indexes. And if you look at the index year to date, the S&P 500, for example, and I'm circling that right now, it's up 13%. That's fantastic. Good year to date number. And, by the end of the year, it appears that's going to be a better than average year, maybe significantly better than average year, with an average year being 8 to 10%. However, what you learn is a lot of years do a lot better and a lot do a lot less. But what you see is if you look at the 5 biggest names in the S&P 500, Amazon, Apple, Microsoft, Google, Nvidia, they're up 47% year to date. And so when you look at that, you see a huge disconnect between these names right here, which are what is driving the market, the index, which is what we kind of attribute to when you hear what the stock market is doing on the news, and the remaining 495 companies. So if I look at this, and I'll pause for questions after the slide, and then we'll go to it, I see a huge valuation difference here. So if these are up this much, this is up this much, maybe these down here, and there's 495 of them, are a better buy than these up here. And I'll stop. Do we have any questions there? Juliana, do you mind watching the chat on that?
Yes, we had a couple questions. I think this person wants to discuss tax-free investments.
Okay.
But not anything regarding the markets or what you're talking about right now.
Okay. I'm going to save tax-free investments to when we were going to talk about tax anyway.
Okay.
Is there any other interest we can attend to now? Sounds like no, unless you got something. Okay. Thank you. All right. So with that, then we come down to, and let's go with this thesis that we're going to continue for this and the next slide. So 27% of the S&P 500 market cap shares consist of only 8 stocks. That's amazing when you really think about, I'm trying to diversify, own 500 stocks. What is their return? But because I market cap weighted, 27% of that return is actually created only by 8. And what market cap means is the larger your company is, the more emphasis it gets. So, for example, Google matters a lot more to the index than, let's say, and I'm just going to say this with a company you know well, Target, which is a great company, but a lot smaller than Google. All right. Then, along with this thinking, and this kind of helped us know we're on the right track, July 24th of 2023, the NASDAQ itself decided it was going to rebalance its index. And so if you think about these indexes, what they do, and let's go back here where we're looking at these names, is they want to own a basket of stocks that represents the entire market. Well, if you're owning these names and they become too big and they no longer overall represent the market, what we're going to have to do is rebalance that. So now what we do is instead of Google being, 10% of our return and Target, for example, because I said that earlier, being 0.5% of our return, we make Google, 9% and Target 1%. And so it just makes it so a little bit more of each company is represented. What that also shows, though, is if this is having to rebalance, how important that might be for us to do as individuals. So what are the opportunities we can move towards and find profits from these valuations? First of all, active management. I'm a big fan of indexing. I'm a big fan of passive management due to human error, but you are getting to a time and have been in a time for a while where I don't know how long it'll take to pay off. But when we go through the next cycle of interest rates going down, as well as earnings and things, lower valued stocks currently, while they're also higher valued stocks, will really pay off a lot. And that's where we're trusting the managers that we're looking at and hiring for you guys to really make the right decisions. The second is, people often ask us, when will we have a cycle change? So when will we go from, the stock market going up to the stock market going down? And the answer is, we have no idea. It is impossible to predict, but one thing I find encouraging about the environment we're in now is that you're able to find a lot of good deals by really focusing on these undervalued stocks when there's been a lot of concentration in the large state names. Okay. And then also, and I just want y'all to know this because we continue to get a lot of questions about international. There's sort of 4 ways you can evaluate any position in a portfolio. Pure valuation metrics is one. Momentum and consumer sentiment is certainly another. Geopolitical risk and environment is a third. And then, future outlook of all those is the fourth. So when I say future outlook on all that, we don't know that, for example, the geopolitical environment and the valuations will always stay the same. So when you look at that, there has been a very, very logical disconnect between the United States and the rest of the world. And we performed a lot better. We've had a stronger economy. We've done a lot better. However, you have to eventually go back to the idea that if business is happening in the rest of the world, there might as well be a good reason why. And if our valuations keep going up and theirs don't, there might be some reason why we want to invest in theirs. And so we're getting to that point with Europe where it's really starting to look interesting. And the valuations between Europe and the United States, which you can see here, the United States being in kind of bluish purple with the entire world index. And then you take that out and you just look at Europe, how it's underperformed, you're starting to see valuation differences. And so what that'll do is give us some opportunities. We also see those opportunities in yields. We see that internationally, but let's go back now. We're stopping the stock conversation. We're talking about bonds. If you think about it, 3 years ago, interest rates went to zero by the Fed, and there's no way we could go out and buy you a fixed income portfolio generating more than 3%. Now we're able to get a very good fixed income portfolio that's paying you closer to 5%. And what that will do is create several opportunities. And as that creates opportunities, we can shift our investments, whether that be to other types of bonds, other types of cash equivalents, other types of structured notes, other types of yield-oriented investments that really weren't there a few years back. So when we talk about the overall return of the portfolio, I don't really see a huge expectation difference, but what I do see is where you might get that return going forward. And one thing I hope we're all talking to you about, and certainly I will be talking about with my clients, is opportunities that are now there due to higher yields that were not there before when interest rates are lower. Okay, Juliana, I'm going to pause for questions and I'm going to interview you after this set of things.
Oh, you don't want to interview me because I will give all the wrong answers because I'm not a CPA. But I don't think we have any questions thus far, but feel free to unmute yourself. I feel like a lot of people know each other or we've seen each other in person. So if there's any questions, feel free to ask David Elder at this time.
Okay. So at this point, I'm going to pause and we're going to talk about a planning idea. If you think about what we're doing in this webinar and you think about like the structure of what we try to offer you guys, it's really threefold, and it's threefold all the time. It's how to help you with your investments. Let's make that better. And part of making your investments better is not just your return, but how comfortable are you with them? How well do you understand them? How involved are you with that? How well are they labeled to what they're supposed to do for you and the next generation of your family? Is this bucketized for this expense, or is this more long dated? When you come to advanced planning ideas, this is stuff outside of investments. So it's really kind of 4 key areas that we're trying to help people with. And we'll talk about tax in a second. So first of all is how to make your money go further. That's always huge. Nobody enjoys taxes. In fact, one of the funniest and best questions I think I've ever heard asked to clients is, which taxes do you dislike the most? And if you infer the logic there, we assume you don't like taxes. Which one do you dislike more than the other? The second is wealth transfer, so estate planning. How do we make sure your money goes to the causes and the people you care about efficiently? Third would be asset protection. So you've made this money. How do we make sure it's not unjustly taken from you? And then the fourth would be charitable giving. So let's dive into asset protection here because it's pretty sophisticated and pretty well ignored. In fact, I'm going to say this, on asset protection, it was a very interesting conversation I had on Monday where a estate planning attorney who's doing pretty well on her own, and I met for lunch and we were talking about some stuff going on in her life financially and mine. And what came out of that was that her aunt's husband had died. She was raising a special needs kid and they had no money going forward. And her aunt lived in Florida. Figuring out how to move her aunt and the kid up to Florida was now a financial problem, as well as there had been no documents set up. And this is an estate planning attorney I was talking to. And then you go back on that, and I said, if we had stress tested your life and asked the question, what problems could come up to derail your financial plan, would you have ever said this was a potential issue? And she said no. And I agree with that. And so this idea of asset protection can be very different around the wealth spectrum. And this is a estate planning attorney who deals with people who are significantly wealthier than most of y'all. And I asked her, I said, how would one of your clients who has $100 million deal with this issue? And she says, well, it wouldn't happen. And I was like, well, why wouldn't it happen? She's like, well, they just pay for it. And so it comes back, of course. And I said, well, if we ran a stress test for them, what issues would we come up with? And so we started brainstorming these issues. And it's so different, but still so important. In fact, most of the issues that came up for the wealthier families don't derail their plans, quite frankly. They have money to handle them. Most of the issues that came up for the average families can really make an impact. So let's dive into this, because y'all have worked hard, and the number one thing we want to do is make sure the assets you've earned and worked for don't get unjustly taken from you. So let's start. I've listed 5 mistakes here. So number one, and unfortunately, this is the world we live in now, and you also see this in the realm of things that seem litigical and other stuff. So 1, start asset protection planning after you are aware you can be sued or have other events. I mean, I can't tell you. I had one client, and then quite frankly, asset protection is where you get the craziest client stories that, they're good to share, but at the same time, like, hopefully don't ever get repeated. So I'll give you a good example of somebody I had here. I had a client who had a car accident with a school bus and wanted some asset protection strategies on what to do if any of those kids or their family sued her between now and when those kids turned 18. Well, if she had had higher limits on her auto insurance and an umbrella policy, that wouldn't have been an issue. Not having enough or proper liability insurance. Okay, so let's talk about this. Sorry, went back. This is 2 things. It can be your car insurance, it can be your homeowner's insurance. And both of those, think about where that lies. But then the third, and I said this is 2 things, but the 2 things it is the car and homeowners, making sure that's right. And then if you get that to the right level, you can add an umbrella on top of it. So what's important about all that? Honestly, you would be surprised at the amount of high valued homes that are underinsured. I will tell you that people who tend to use captive insurance, meaning companies like State Farm, Allstate, what will happen for them is they just renew, and they don't realize that all of a sudden they have a property that's worth $2 million, but they only have insurance for a property worth $700,000. And that can just happen because they got their State Farm when they bought their house for $700,000, and now it's appreciated. So we want to make sure you have enough. Failing to approach asset protection planning in coordination with your other wealth planning efforts. So if you think about this, 1 and 2 is really about those assets directly. If you think about number 3, this is things like taking it across generations, assigning in your portfolio which assets get protected versus which are unprotected, and deciding in your own portfolio which you're going to spend versus which you might put towards other endeavors. For example, money I want to set aside for a rental property I have somewhere. First of all, I need to have that insured in a certain way, but I also want that money aside so it's there in case an issue happens with that property and I can segregate that out on my own. Number four, not understanding what you did and why. All right, so let's go back to these. These all seem pretty on the surface. This one's a big deal, number four. And the reason it's a big deal, and think about this when I've told many of you to go to estate planning attorneys and other professionals in the past, the reason this is a big deal is sometimes, and you think about this idea of really coordinating your professionals and having us all work together, sometimes you don't know what you got. And whether it be protecting a rental property in Florida that you're renting out that's in an LLC, or ensuring a new renovation you did on your house, knowing that that's in place, understanding the difference between your insurance policies and the legal entities and how those protect you, and then also thinking about things like future risks you may incur with family members and other folks, and then understanding how that's all covered. Huge question. And all I can say is if a hazard happens or something happens, this will make you better at handling that at the time of an emergency or at the time of this type of planning making sense. And then finally, failing to work with a skilled professional. And I will say this, back to this idea on number four of not having enough insurance to, or from number four back to number two, of having enough to properly insure the property. A good professional should help you with that. And then finally, and I threw this out in some ways because I think we can help y'all, and in some ways, I think this is a fun challenge for you guys. And those of you who've worked with us for a while know we love being creative and trying to come up with solutions. If you're unsure how well your wealth plan is safeguarding you from frivolous or unfounded lawsuits, consider stress testing your current plan. So a stress test, what that really looks like is us helping you while you do this on your own of just brainstorming possible problems. And then once we brainstorm those problems, let's come up with solutions. Not that we're going to solve all of them, but we're going to put a plan in place to protect them from spilling over and causing other problems for our assets. I'll give you a great example, and this, I mean, you might go, oh, this is a quintessential risk management, but I'll give you a good example in my life. If I was stress testing it, and I was thinking about what would happen to my family if I lost my job, I would need to think about all the things that we're doing. I would need to think about what's important. I would need to think about, what other income I might have, et cetera. If I was stress testing, figuring out what might happen to my family if I passed away, that's a totally different question, and we start getting to totally different answers. But all of those matter in a lot of different ways. So the main thing I would say on this is we're not trying to set plans in place for you right now. What I'm trying to do with this, and if you look at the first two parts of this presentation, they have very different initiatives. The first part was help you know what we're looking at in your investments. Your second part is to help you know what you should be thinking about. It's mainly brainstorming, listing what could happen here to you. And then let's see if we can put a plan in place to make sure whatever that is happens and that's not taken away. Juliana, I will pause for any other questions, and then we will get to some conversation about tax in a second.
I don't see any questions besides the one question we had about the tax-free investments. So I think that's the only one for now.
Okay. All right. So let's go to, and this is a picture of Juliana. She's going to be our guest speaker today. Juliana began her career at a nationally recognized, no, I'm just teasing. Or she can help you with emojis. So let's start. So we had planned on bringing in and I'll just go ahead and put this here, and you guys can scan this if you want to set an appointment with me, or we can set it with Kat. And I have some bullet points on the things she was going to talk with, but I'm going to address the question first. Unfortunately and fortunately with CPAs, unfortunately, they're very busy people. Fortunately, what we're trying to do is create some relationships so we can bring that more easily and help you guys both with tax advice as well as tax compliance, and tax planning as well. So we're going to talk about the three things she talked about, but there was a question about tax-free investments. And then beyond that, anything else come up, Juliana?
Nope, I think that's about it for now, unless anybody
Okay.
wants to mute themselves.
All right, so there were three things that we were going to talk about with Kat specifically. We're going to talk about end of year because that's coming up. We're going to talk about charity and ways to maximize that. And we're going to also talk about 401k changes. And 401k changes are more important for people that are working, but let's get to all of those. Okay, so
David?
end of year.
David,
Yes, sir.
so with respect to the discussions you were having, what percent of your either the value of your house or your net worth, however you want to look at it, should your liability insurance be, your umbrella policies and stuff like that?
Yeah, that's a great question, Jeff. Here would be my take on it is before I start introducing legal entities, I would get an umbrella and liability coverage up to about 100% of my net worth. After that, I would consider, what can an LLC do? What can a revocable or irrevocable trust do? That sort of thing.
That's okay.
And I'm sorry that just cut out over here. I might just come back and let's talk on Teams. I'll stop sharing. Do you know why I said that, Jeff?
That's a bigger number than I thought you were going to say, but okay.
Well, that's why I asked if you know why I said that.
So, David,
and it may be different for somebody in your situation where you're retired and we're paying down the money. But what I would say, and I think this is pretty true across the board, is you'd be shocked at how cheap this is. So if we're talking, am I spending $300 a year versus $600 a year on insurance? I don't know why I would debate that when you consider what is, at stake if something bad happens. Especially you, Jeff, and I'm seeing you and my mother-in-law on the line. Y'all both live on a lake, so you guys have different issues than the rest of us.
So how much do you think like a $2 million umbrella should cost? I mean, I have all my stuff bundled together, and I know individual pieces can be crazy at times.
Yeah, question for you there. What are your current liabilities on your homeowners and car insurance?
Theoretically, the homeowners is whatever the house is worth. Cars, got the state minimum because you got the umbrella backing it up.
Okay. All right. So I don't know what carrier you have. What you said sounds weird. So I'm guessing it might add up differently.
Yeah, it was State Farm, and in total, when you bundled everything together, the total was less than what Safeco was, even though some were a lot higher, some were a lot lower.
So here would be my issue with what you said about State Farm. I don't think your rates are bad, but I do think you need to maybe reach out and be 100% sure that it's covering the full replacement value of your house. And here's the way you can tell. It's not any problem with State Farm as a carrier, but sometimes if you're with them long enough, they just keep renewing. And Fred, I know enough about you guys to know you've been where you are long enough where your house has gone up in value, and you could either tell them that number and then they get it right, or they can send an inspector out. But that's what jumps out at me. And the other thing you said was state minimum, which, I'm not saying you're wrong. You might be right there, but normally they make you have above that limit. Normally you do 250, 500, which means 250 per accident, 500 liable, before you can
Yeah,
get an
yeah,
umbrella.
it was whatever they said I had to have as the minimum on the car insurance.
Yeah, I mean, as long as you get the minimum they say to put an umbrella on top of it, you're probably covered for enough, but I would be concerned about what you said on the house, possibly. That would be my
Okay.
take on that stuff. Thank you for asking. And then the other thing you might be surprised at is, you asked the question, what is a $2 million umbrella? If you already have a $1 million umbrella, you would think it's times two. It's not, because of all the administrative and other costs that go with it. There might be my umbrella at 1 million costs, and I'm just making this up, Fred. $500 and $200 that's fixed, which means only $300 is insurance. So now I can get 2 million for 800, something like that. Yeah.
Okay.
If you want that reviewed, we can connect you with somebody, or help
Okay.
you. But yeah, all right. And I'm so glad that resonated with somebody, because that's a big issue. And especially, we went back to COVID and what that did to the economy, but think about what that did to most of you guys in North Fulton and your house values. I mean, your houses are sitting there worth, on average, probably twice what they were in 2019. So congratulations, but let's protect it.
David, so I guess, actually Brenda and I are going to redoing our policies now. And what I was looking at is, and from an insurance point of view, not liability, but just replacement cost. The replacement cost shouldn't be as much as the house is valued at, right? I mean, you're talking about rebuilding the house. It's not necessarily what the sales price of the house is.
I 100% agree with you, Jeff. But you also have to factor in land versus home value. And normally they insure the infrastructure in a different way than they insure land. And I think that also depends on where you're living. So yes, perfect issue. And especially, and Jeff, you don't mind me saying this. Do you mind me saying a little bit about you?
No, go ahead.
Jeff lives at the lake, so he's got really good home value, whether he has a house or not. Other people don't.
Well,
So, all right.
it's gone up a lot in the last 20 years, but I think what it would cost us to rebuild the house is less than what it would sell for.
Oh, yes, 100%. But part of that, and what I'm getting at, is how much value your land has versus, like, my neighborhood, and which isn't on water, where it's a little less significant, the land value versus the house value. That's it. And I'm not saying that my land's worthless. I'm just saying you need to price that difference for different situations. That's all. Yeah.
Mm-hmm.
And the other thing I would actually say, and this is why it's become so individual, figure out also, is your house something people are going to want to keep, or is your house something they're going to tear down either anyway? And the other place it becomes so individual is, what is your property? Where's your value coming from? Because there's some value that comes from just the land. There's some that comes from the building, and making sure that's insured properly. So there you go. And one more thing back to the lake, which is dear and near to me as well. You might not need it on the house, but my gosh, the liability that can come from accidents and things that can happen on your boat or docks, might make you be willing to spend $400 that you wouldn't spend otherwise.
Right. Understand.
Okay. Yeah. Any other questions? You guys are great. I love it when you ask questions. All right, let's get into some tax stuff. So from the conversation I had with Kat, and then also some other stuff tax-wise, it's just important for us to talk to you guys about this time of year. And I know we have individual stuff to follow up from each of y'all here. All right, so first of all, end of year. So remember, from a tax standpoint, unfortunately, stuff has to happen in the calendar year. So when you think about things like your 401k contributions, for example, or your Roth IRA or IRA or SEP contributions, those can happen the following year. From like a charitable giving or deduction or several other things, they have to happen this year. One of those, and let's just go down a list of things I would be considering if I was y'all before the end of the year. And the reason I'm talking about this now is some of this might be stuff you know you want to do. Some of it might be stuff you want to think about. Also, some of it might be stuff you know you want to do, but you're not sure how you want to do it. So we want to decide, are you doing things like using appreciated assets? Are we putting money in a donor advised fund? Are we giving cash? Are we donating directly from an IRA? Those types of things. We want to figure out first, what are we going to give between now and the end of the year? And then second, how do we do that most efficiently? So first question I would ask between now and the end of the year is, what do you want to give? And I will tell you guys, if any of y'all are giving gifts between now and the end of the year of above about $3,000 to $5,000, depending on what the gift is, we can probably help you get a bigger deduction from that gift than you would without consulting us. Okay, so put that as your what to do. There are also things, if you know you want to give a gift in the future, but you want a deduction this year, we can make that deduction happen, but not give those gifts in the future. So a great example on that might be, I know I want to give to a certain university in the future, but I'm not exactly sure what I want that scholarship to look like. Or I have this money I know I want to give, but I'm debating about doing it to my local church or a university. We can go ahead and get you that deduction and later make that gift if we're trying to decide where it goes. A second thing I would do before the end of the year is decide if we want to do a Roth conversion or not. And I will tell you the math on this because there's a lot of folklore around Roth conversions that is just wrong, and a lot of just talk about Roths that is wrong. So the idea is, if you're going to be in a lower tax bracket today than you're going to be in the future, you want to make a Roth conversion or contribute money to a Roth. Okay. And the same is true the opposite way, which would say you don't want to make a Roth conversion or you don't want to give money to a Roth. And so what will happen if we do that is we pay the taxes now, but then we pay lower in the future. So who is this a good candidate for? And I just want y'all to think so these wheels start turning. I got a few people here. First of all, I think it's a great question for people who have saved a lot of money in IRAs and might be in a higher bracket later on from a tax perspective due to RMDs. So if you have $1.5 million or more in an IRA, let's go ahead and talk about if we should go ahead and do some of these, whether it be small or big, if tax efficiency is important to you. It is also for people who are making contributions and may want to do to a Roth. We'll talk about that when we talk about the 401k changes. And then the final would just be simply people, and I've had this in my career. I don't recommend it personally. I actually think it's very bad planning, but it might be something that matters to you personally, and we can help you execute that, which is, I just think politically, taxes are going up. 12 years ago, I would have told you that was a no-brainer. Today, I would say I thought 12 years ago that was a no-brainer, and all they've done for the last 12 years is go down, so I can't tell you about the next 12 years. But yes, if you believe taxes are going up, I have people who have said to me in the past, I'm going to be in the same bracket, but I want to go ahead and do this because, and then we've looked at the math, and let me tell y'all something comforting about this math. If you're in the same bracket, it doesn't matter whether we do it or not. You can do it or not based on your own comfort. However, if taxes do go up, that could help you. And some people just believe that's going to happen. Actually, just to tell you all a story so this doesn't happen at the end of the next election cycle. Certainly with the current administration come in, we had a lot of Roth conversions and taxes haven't gone up. So there's that. And the third end of the year thing, if anybody's contributing to a 401k or still working, the IRS going into next year, I believe, changed the way the spillover contribution works. And what's going to happen with that is we're now going to get from the tax deductible part over to the after tax part sooner. And so if you're in that category, just call us and we'll talk about what to do, hopefully sooner than in the past, on rolling some money out to Roth IRAs throughout the year. So that's one aspect of end of year planning. And then the final aspect, and people act like this is important, just know we do this for you, like basically without you doing anything. It's happening, but tax loss harvesting. And we have a lot less of that this year, thank goodness, because markets have gone up. But we certainly have enough where if y'all have losses in taxable accounts, we'll make sure we do that. So those are just a few things I wanted to be sure y'all are all thinking about before the end of the year. None of that probably matters to all of you, but if it matters to some of you or you individually, please give us a call and we'll help you work through it. So I will pause. We have 10 minutes left before 1. First of all, it's great seeing you guys again. I would love to start doing one of these monthly as long as we have the interest. Does anybody have any other questions or feedback or things they'd like us to cover in future months that we didn't talk about today that they'd like to do?
There's
All
a
right,
question that
Juliana?
just came in. There's a question that just came in. Will the downgrade of the U.S. credit rating present any investment opportunities?
Probably, and I see who sent that in. You're always full of good questions, Ed. Probably will, and I'll tell you why I think it will, but not that it has yet. I mean, you got to realize that that happened last week, and the bond market moves much, much, much slower than the stock market. And by that, what I mean is a lot of times you'll see a stock market reaction within like 30 seconds of news, and you see a bond market reaction within like 5 days. So, there's a different definition of time here. But I think it will create some investment opportunities. And here's why, Ed. I don't think, and you got to understand there's a difference between market expectations and ratings organizations, and then also public expectations or published expectations. Let's say that. So I think, from a ratings company expectation, neat, they downgraded us. Awesome. They can do that. Fantastic. What if you look at all the rating organizations, what they really are is just a business that tries to make money by giving people ratings. If you look at more the how do you analyze this, like on just the financial level, this is a really bad thing. But if you look at the market and what the market has said, which I think is smarter than the academics, I think it's smarter than the ratings agencies. I think what the market is saying is we don't care. And I think that's a great new paradigm when you're coming to investment analysis, because all of a sudden these beacons of ratings, whether it be Moody's or S&P or Barclays or whatever else, they can do what they want, and they're doing it very well based on certain kind of qualitative things, but they're not doing it based on actual market expectations. And so what I think this is proving and showing is some inefficiency in the treasury market and some inefficiency in the bond market. Now, where that inefficiency manifests, I will say, is yet to be determined, but I think it's going to happen, and that does create an investment opportunity when it does. Yeah. And a lot of times that's where investment opportunities come from. It's from, or better than just market rate opportunities come from. It's from some type of inefficiency. Because if something's perfectly efficient, that means you already expected it to happen. So that's it. And then the other thing is, I do think there's some efficiency in the market, which is why it didn't react. And you could say it's priced in and everything I just said is bogus, but I don't think it's a bad thing at all. Anybody else? Great question. And feel free with y'all's questions to either type them in or talk them in, whichever you prefer. All right, well, I will go ahead and wrap up if that's it. So let's just do a summary. That was a ton of stuff, and we hope to continue doing a ton of stuff each month. The goal here, just to get it, is not for you to take this and, I did have a question pop in. Juliana, do you mind reading what Mike said?
Yeah, absolutely. It's how much can you move from a 401k to an IRA?
Very loaded question, Mike. Let's do that offline. But the answer is unlimited. It all depends on how much tax you want to pay. Like, we can convert the entire thing if you want to. But I bet what you're asking might be the heart of more people is related to their Roth money and their after-tax money, which is that stuff can move out at any time. And so if that moves out, sometimes what you find is better tax treatment down the road if that money's there. Now, the way you find out if you have that is just looking at the sources, or what I was talking about earlier on the question on 401k changes and tax-free investments, which actually I'll come back to in a second. I realized we didn't answer that, is you're going to have to be saving a certain amount of money before that impacts. And so if you are, you're going to be rolling out the portion over that, which can be any amount you save. It's just a matter of how long does that, how much can you do, quite frankly. Any other questions? I'm gonna get back to the tax-free investment discussion. I'm not going to read who that came from because I think we've already read who a lot of these come from. Tax-free investments, just because we had a question come in. Here's what I'll say about tax-free investments. You have to realize that, back to the core of economics, there's no such thing as a free lunch. And they only matter in a sense if people are already paying a lot of taxes. So if you don't have the problem of being the highest tax bracket, they usually don't help you. Now, there are tax-deferred investments and Roth investments and things like that, but when we're talking like municipal bonds or things of that nature, or Georgia film credits or things of that nature, or conservation easements, that you need to be in a high bracket for that to happen. But for most stuff, I think the tax-free investment I would look at is getting that money went efficiently to a Roth, and then also deferring money, whether that be through the investment accounts or annuities or whatever structures. And then finally, with tax-free, municipal bonds are always an option, but those really don't impact many people until they're in the highest bracket. So there you go. Anything else? All right, y'all have been awesome. This has been fun. I will say that if y'all have any topics you want in the future, we're going to keep it to that three-prong approach of part on investments, what we're doing with your portfolio, part on advanced planning, what we're doing to help outside the investments, as well as ideas to protect your tax efficiency, estate planning, asset protection, and charitable giving. And then fourth, other ideas from other professionals and other disciplines. If there's anything y'all want in that covered, please email, or excuse me, third, please email or let us know. And then the fourth is, of course, you guys as the audience. So let us know. I will plan on bringing this back on a monthly basis. If there's value, it seems like there is. And as long as that continues, hopefully it gets better and better after month, and really appreciate y'all's time and seeing you.